Welcome back. This week I'm continuing my discussion on real estate. And last week I talked about 6 ways to make money from real estate, and one of those ways was investing in rental properties. So I want to follow up on that and talk about 7 things that you should know about investing in rental properties. And this could be if you're looking to invest in your very first rental property, or maybe you are already invested in a rental property, maybe accidentally you inherited it and really don't understand it. So we'll talk about these 7 things that can help you to make the most of your money if you're getting involved with this. So number 1 is, how do you make money with rental properties, right? So rental property is where you own some kind of real estate. It could be commercial real estate, it could be residential, and you are making money from that. One way is through the cash flow, meaning that the rent that you receive minus your expenses hopefully is leaving you money left over. And if that is a positive number, that's a good thing, because that's what you want, and that's your positive cash flow that you're getting from the property. Let's just say you collect $1,500 a month of rent, and your mortgage, including taxes and insurance and interest, is $900 a month, and you have $150 a month maintenance costs and a property management fee of $150, and then you allot a little bit for vacancy of $150, then you're making $150 a month of positive cash flow on that property. And the other way that you can make money on real estate is from the appreciation of the property. And this is definitely more difficult anytime you're buying a rental property, because you don't really know what the future is going to bring as far as appreciation. Maybe you bought rental property a few years ago, and it's possible, because the real estate market where I am in Connecticut has been pretty strong. Maybe it's actually gone up in value. But you might buy a rental property and it might sit there for a number of years and actually not go up in value. It might actually go down in value. And I guess that's okay as long as the property that you buy has positive cash flow. So you want to be very careful anytime you're buying a rental property to make sure you're doing your due diligence on what the potential rent is, as well as the expenses that you're going to incur by being a rental property owner. And I can tell you, I mentioned in last episode that I own a number of rental properties, and almost every time I've been painted a more rosier picture by the real estate agent that's selling the property. And this was even sometimes by the real estate agent that was representing me. And that could either be because the agent didn't really know what they were talking about, or maybe they just wanted to sell the property. Who knows? But you want to do your due diligence on the rent. And I recommend looking online in your area using Craigslist or maybe Realtor.com to see what other properties are listed for. And there's another website I use too called Rentometer, which is a free website where you can put in your zip code, the size of the property, the number of bedrooms, and it'll give you a range for the rent. And you can also experiment. You could list it higher maybe than you thought maybe you could get, and then see what the market will ultimately bring. And you can always lower the price if you're not getting the demand that you want. But you want to be careful and not overestimate that you're going to get a high amount of rent and then find out you're not going to receive that, and now maybe the property turns out to be one that's not making money for you, or maybe it's kind of just barely making money for you. The second thing to know should be the primary reason that you're doing this, is what is your potential future return. And the professional way to calculate this would be to determine what your cap rate or capitalization rate is on the property. So using that prior example that I had, let's just say that your rent is $1,500 a month, and you have fixed expenses that you have to pay of $500 a month. This would be excluding the mortgage. You don't include the mortgage. You'd include your taxes, insurance, or any other maintenance costs. So that leaves you $1,000 a month. And let's just say that you could buy this rental property for $100,000. So you would then divide the purchase price of the rental property by the expected net amount that you'd receive. So you would then divide that $1,000 a month annualized, which is $12,000, divided by $100,000, and that gives you 12%, which would be a capitalization rate of 12%, which would be very good. This is your expected annual return. So you want to determine that for any potential property that you're buying. And if you find that you're not finding very good cap rates, if you're looking at cap rates of 3 or 4%, then you might want to ask yourself, why are you doing this? Because very easily you could most likely invest that $100,000 into the stock market, and over time you would make 3 to 4%, if not greater, without having to do any of the headaches of owning rental properties or having to come out of pocket for any other expenses. And another thing you want to think about too, when you're buying the property, you definitely want to have a home inspection done, and you want to try to get an idea of what potential expenses could be coming down the road that you would have to incur, such as putting on a new roof, fixing a heating or a cooling system, any renovations that need to be done, if a driveway needs to be repaired, the house needs to be sided, new gutters, painting, whatever these things are, you need to build them into your budget. Because even though you might be getting a good deal on a rental property, if there's a lot of maintenance down the road, then you need to factor that in, and maybe you want to avoid buying that property. Anytime I buy a rental property, if I'm not getting an amazing deal on it, I'm often looking to buy a property that's in excellent shape, even if I'm paying more, because I'm okay paying more knowing that I don't have to come out of pocket for a number of years for any of these expenses. The third thing to know is the tax advantages that rental properties come with. And the benefit that you really get from rental properties, the tax advantage, is that all the expenses that you have from the property are all deductible against your rent, as well as when you first purchase the property, you're able to then deduct the value of the property plus the land over the next 27 and a half years against your projected rent. So let's just say, for simplicity, you're paying $275,000 for a rental property, then you can deduct $10,000 a year against your rental income for that property. So because of this ability to offset the rent against the expenses of the property, you might find yourself in a situation where you have a good property that has strong cash flow, but you're not really paying much tax every year on the property because of the depreciation and expenses that you have. Now, you probably should expect to pay some tax, because if the property is not making you any money, that's probably not a great thing, because most likely you're losing money and you're having to maybe go into your pocket and pay for things. But the beauty of this is that you don't have to do anything special. You're allowed to do this, and if you do your taxes yourself, make sure you're doing this. If not, any good accountant will make sure that you're accounting for all the expenses that you have. And I actually track all my expenses. It's in a very simplistic way. I have a little Excel file, one for each of my properties. Anytime I have to spend money on a repair or go buy something from the store, I keep the receipt, and then when I get a chance, I enter it into Excel. Just makes my life a lot easier when I get to the end of the year, so I don't have to then go and dig out all my receipts, look through my bank statements, look through my credit card receipts, figure out what I paid for things, because it's very easy to forget. And that way I can make my tax preparation a lot easier at the end of the year, because I know for each property what the out-of-pocket expenses were as far as repairs and maintenance. Where you do have to do some research is that you need to also know what your taxes are that you paid on the property. And that's easy. You just have to go to the town website where you pay the taxes, but don't forget about that, because that also is an expense that you're able to deduct as well. Or if there are condo fees, those are deductible also. So the fourth thing to know is, how do you buy the rental property and how do you finance the purchase of it? There's a couple different ways. I guess the easiest, but probably not the best or smartest way, would be to use cash. You could use cash to buy the rental property. And why I say this isn't the best way is because you're not getting a lot of leverage on your money. Let's just say you're going to buy one property for cash of $100,000, and that was going to net you $200 a month. But instead, you could take that $100,000 and buy 3 properties, and now you'd be getting $600 a month. That's where you benefit from leverage. Now, obviously, you're paying interest, and you'd have to factor that in, but by leveraging and buying more properties, that might actually make you more money even after paying interest. And you'll also benefit, too, because you own more properties. If property values go up, you're actually getting more of an increase because now you own more properties. If you're going to borrow and use some type of leverage, most banks will require you to put 20 to 25% down. The remainder of the purchase price you'll be able to borrow. And so that means that if you're buying a rental property, let's say for $200,000, you need to put 25% down, then you'll need $50,000 plus closing costs. So that's where it can be a little trickier when you're buying a rental property as far as making sure that you have the money to put down as well as the closing costs. And I would say most closing costs, you need to talk to a mortgage broker or a bank about that, the specific property, but usually anywhere from $10,000 to $20,000 would be the expected amount of closing costs when you're buying a rental property. Now, if you can find a rental property for $100,000, then your closing costs will be even less, as well as the amount of money down. I would say it's where I am in Connecticut, it's gotten a lot more difficult to find rental properties that are selling for a reasonable price because most real estate markets in Connecticut have been very strong. So rental property prices have gone up. It's been great if you own rental properties and you're looking to sell them. But if you're looking to buy them, it's become more challenging. You could obviously look to other areas outside of where you live, as far as maybe areas where the cost of real estate is less. If you live in the Northeast, maybe you look out to the South or to the Midwest. The difficult part with that is now you have to have someone else that's managing it for you, and that may or may not be something you're comfortable with. So another option too is that if you don't own a house currently, or you're looking to move to another house, then you can buy a rental property as an owner-occupant. And this is a way that you can really cut down on the amount of money that you need to buy the rental property, because through various programs such as FHA or the VA, you can put as little as 0% down if it's a VA loan. So that really minimizes the amount of money that you need to buy the rental property. You'd still need the closing costs. And with FHA, I believe it's 3.5% down. And this would work great if you're buying a multifamily rental property, because that way, if you're buying a 2-family or a 3-family or maybe even a 4-family rental property, you can then rent out the other units, and hopefully the rent of those other units is strong, and maybe it even completely covers your mortgage. And if that's the case, then you're living in the rental property completely free and you're building equity. Maybe it covers just a large portion of your mortgage payment. So those are the ways that you can finance it. And then once you're in the rental property, you also have the ability to refinance it down the road. Maybe you bought a rental property a while ago and now you've done some repairs, you've made some improvements, and you can go back to the bank or maybe another bank and you can refinance, and maybe you can get some money out possibly. That's one thing. I've seen people do this where they refinance and they're able to get out all of their closing costs, maybe a large amount of their down payment, and then they look to take that money and do it somewhere else. That's going to work best if you're buying rental properties in a market that's going up. And one other option I didn't mention earlier is that there's also something called a 203K loan, an FHA 203K. This is where you're able to buy a rental property that you're going to live in, and then you are able to also borrow costs to renovate the property or fix it up. And you have to have all that lined up in advance, and it can be quite challenging because there's a lot of paperwork that goes along with it from what I've seen with other people that have dealt with it. But it is a way that you can have your rental property purchased with a low amount of money and also not have to come out of pocket for the closing costs. So number 5 is, what type of rental property is the best rental property? Well, that really depends upon what you are willing to deal with, I guess, and maybe what's available in your market. Probably the easiest to deal with would be a single family home, because you're just dealing with one tenant, one property. With single family homes, the tenant usually is responsible for all the maintenance of the house. So they have to do the snow plowing, the lawn mowing, the landscaping. They're paying all the utilities, so every utility is in their name. Multifamily properties can also be a good deal. It really just depends upon what the cash flow is. But with multifamily properties now, I do own a few multifamily properties. You are responsible maybe for some of the utilities, because usually there's common utilities such as outside lighting, hallway lighting, and most multifamilies have what's known as a house meter, which is an electric meter specifically for those utilities. So you as the property owner would pay for that. You'd pay for the water bill. You'd pay for the sewer bill. These bills cannot be put into tenants' names, and that would be something that you just have to build into the lease, build into the price that you're charging. You also have to usually pay for all the landscaping, lawn mowing, snow removal, and any other costs that you have to pay for, maybe cleaning of the common areas every once in a while. So those are additional challenges that you have, and now you're dealing with more tenants living in one area, and there can be conflicts. I've had some tenants that have had fights. I've had to evict tenants because they were fighting with each other and the police were coming every day. So these are all challenges that you deal with when you own a multifamily property. Another option too is you can invest in commercial real estate, and I've been told that commercial real estate is a great thing to own for the number one fact that people don't live there, right? People come to an office, they do their work, and they go home. So there's a minimal amount of wear and tear on most commercial properties. You don't have to deal with the typical things that you deal with as a landlord, as far as late night phone calls for things breaking or people locking themselves out in the middle of the night. But it is more challenging to buy commercial real estate because it's usually more expensive, and there's other issues that come with that, as far as larger renovation and repair costs. So you have to really understand what you're doing anytime you're going to get involved with that. And really a newer way to buy a type of rental property would be the rental property that's a Airbnb or VRBO or vacation type rental property. And obviously these have been around for a long time, but because of these websites, it's now maybe easier than it was before to manage one of these. Before, you'd have to have a rental agent, and that rental agent would be dealing with the potential renters, and they'd be handling all that information. Now, you can use Airbnb or VRBO to do this for you, and I'm not sure if it's that much cheaper, but it's maybe an easier way to do it. And again, you have to look at the cash flow of these properties. Maybe you're able to make more money with these, but you're probably dealing with some larger ongoing maintenance costs. Maybe you have to make updates more often, because someone that's coming in and renting a house from you for a couple nights is probably not going to put the same care into it as that if they have a long-term lease with you. So you have to weigh the pros and cons with doing that. And number 6 is, I mentioned this earlier, but how do you manage the rental property? Do you manage it yourself? Do you use a rental agent, some type of a realtor to help you with this? Well, it really depends upon what you're willing to do, right? You can put in some sweat equity. You can manage it yourself. You can rent it yourself. So anytime something goes wrong, they're going to call you, and you could fix everything yourself. I wouldn't advocate that. I would put together a list of some repair people that you have on standby, maybe call them in advance, figure out what their rates are, and have a plumber on standby, have an electrician that you can work with, and probably hire someone to mow the lawn and also do the snow removal so you don't have to deal with those things. And then if you want to do full management, you could hire a rental company, property manager, and they'll take care of everything for you. They will find the tenants for you. They will collect the rent. They will manage all the repairs. So you can really get hands-off, but obviously the more hands-off you get, it's going to lower what you're making on the property because you're having to pay the rental property manager to do that. And most property managers will charge you like 9 or 10% of the rent. And for them to rent it out, usually they'll charge you 1 month's rent. So you can save some money by doing all this yourself, but it might be a bigger hassle than you want to deal with. And the seventh thing to know is, where do you start? Let's say you're really interested in rental properties, and how do you begin? Well, the first thing I would tell you is that if you're like my typical listener who's someone approaching retirement, I would caution you about getting into rental properties. As someone who's been doing it for over 10 years, is definitely something that is very draining sometimes mentally. It can be very exhausting. So if you're not looking to complicate your life, then don't do this. But if you are, then I would start by looking at your local area, reaching out to a real estate agent who can help you search for properties, or doing some searches either online with Realtor.com, Redfin, looking for rental properties, setting up some alerts to see what comes available. And then once you find a property that is a fit, reaching out to that real estate agent and talking with them about potential rents, and doing your homework as far as the expenses of the property. It's really great if the person selling the property provides you a pro forma, some type of report that shows you what the rents are, what the expenses are, so that you have an idea. But I wouldn't trust that. I would then ask to see a copy of their tax return. Because on the tax return, they report to the IRS what the rent they received is, as well as all the expenses. And you know that they want to get as much of a tax deduction as they can get, so they're going to report all the expenses that they have. So that way you'll get a full accounting of the expenses. Now, they could possibly cheat on their taxes. Maybe they make up additional expenses. Maybe they receive some rent in cash so they don't report that. But hopefully everything on there is accurate. And then, do some additional research on Craigslist, on other rental sites to get an idea of what the potential rent is. And maybe then deduct maybe 10 or 15% of what you think you could get to make sure this thing still works. And then you could also consider looking outside of your typical local area. Someone gave me some great advice a long time ago, and that was, if you're going to own rental properties, own them within 25 minutes of where you live. And I would agree with that, because you don't want to be driving 45 minutes, an hour, having to go to the property when there's a problem, when there's an issue. You want to make it within 20 to 25 minutes. And anything further than that, if you're going to be managing it yourself, I would strongly encourage against. So I hope that you found this episode on 7 things to know about rental properties beneficial. And if you're enjoying these podcasts, please subscribe. Go to Apple Podcasts, type in Retire with Ryan, and you'll find my podcast there, and click subscribe. And if you haven't left me a 5-star review and some comments about what you enjoy about the podcast, you can also leave it right there in the Apple Podcast app. Have a great week, and I look forward to talking to you next Wednesday, where we continue our discussion on real estate. Take care.